Most people feel responsible when they save a little money every month. Maybe they put away $100 or $200 and feel like they are doing the right thing financially. But then one day they check their bank account and realize something disappointing. Even after saving $10,000, the bank only pays around 0.5% or 1% interest. After an entire year, that might only earn about $50. Saving money is important, but saving alone will never make most people wealthy. Saving protects your money. Investing grows your money. That is the difference many people never fully understand until much later in life. The real power comes from compounding. Imagine putting $10,000 into a savings account earning 1% interest. After 20 years, that money would grow to around $12,200. Now compare that to investing the same $10,000 into the stock market through something like the S&P 500, where the average historical return has been close to 10% annually. Over 20 years, that investment could grow to nearly $67,000 because of compound growth. This is not just about math. It is also about psychology. Saving feels safe because the money does not move much. Investing feels uncomfortable because markets go up and down. Many people panic when they see temporary losses, even though long-term investors understand that volatility is normal. That is why moving from saving to investing should happen step by step, not all at once. The first step is building an emergency fund. Before investing a single dollar, people should have enough cash saved to cover at least 3 to 6 months of living expenses. This money is not for vacations or shopping. It is there for emergencies like losing a job, medical bills, or unexpected car repairs. An emergency fund prevents people from being forced to sell investments during bad times. The second step is separating money into two mental categories. One category is safety money. This is the money meant to stay secure and stable. The second category is growth money. This money is designed to grow over time, even if it experiences short-term ups and downs. Thinking this way helps investors stay calm during market swings. The third step is starting small. Many people believe they need thousands of dollars to begin investing, but that is not true. Someone can start with as little as $50 or $100. At the beginning, the goal is not getting rich quickly. The goal is building the habit of investing consistently. The fourth step is choosing simple investments. Beginners often jump into risky areas like day trading, options, or cryptocurrency without understanding how dangerous they can be. A smarter approach is starting with index funds. Index funds spread money across hundreds of companies at the same time, reducing risk while still providing strong long-term growth potential. Even famous investor has repeatedly recommended index funds for average investors. The fifth step is staying consistent and disciplined. The most effective investment strategy is often the most boring one, investing regularly every month. For example, investing $300 every month with an average 8% annual return could grow into approximately $285,000 over 25 years. Out of that amount, only about $90,000 would come directly from personal contributions. The remaining growth would come from compounding over time. Many people panic during market crashes because they see falling prices as danger. Long-term investors often see crashes differently. When markets fall, monthly investments buy more shares at lower prices. Then, when the market eventually recovers, those extra shares can create significant long-term gains. Saving money is like keeping seeds locked inside a box. The seeds remain safe, but they never grow. Investing is like planting those seeds in the ground. At first, nothing seems to happen. It may even look messy and uncertain. But with enough patience and time, those seeds can grow into a strong tree. In the end, saving provides stability, but investing creates freedom. The earlier someone learns to combine both, the stronger their financial future can become.